Hi, it's Rapture. You're watching In Tune with Real Estate. We're back. We're talking about RSPs, how to take those RSPs and invest it in real estate. You become the bank. The number to call, 905-595-5483 is the number. Mark Vosylius, the guru of RSP investing, is on the show with us. Mark, Valor Capital. That's kind of a neat little thing you got going on. You and two partners came together and said, hey, there's a lot of people that we need to help to make money with their RSPs. And so you brought this. Talk to me about the inception of Valor.
Well, that came, like in most things, I like to look for holes in the market. Yeah. And you look for what supply and demand. When there's a lot of demand, and everyone I talked to, when I started looking at the second mortgage aspect or using RSPs to invest in property, I started saying, you know what, I wasn't able to get the returns because when you talk about a cash flow property, the max you can start giving is 6, 7, 8%, because after that there's no money left from cash flow. Right now, as most people probably know, the price of a home versus rent, if you're cash flowing, you're doing real well, unless you bought a few years ago. Well, right now it's hard. 5% cap rates.
Or you have a duplex or a triplex or something like that.
So I started looking at alternatives. I start with and exactly that word is the alternative market, the exempt market. I started looking into that, and through that process, Rav, I started really getting my hands on to understanding how the big developments are structured. You got debt, you've got equity, and it seems that people like to be secure with a mortgage. So to maintain that.
So when you say the word debt, people think personal debt. That's not what you mean.
No.
There's two types of investments.
Absolutely.
One's a debt investment, and that is where we're lending somebody the money as a mortgage.
Yeah, and what I'm referring to the developer now. Okay. I'm referring to the person that or the company that you're going to be investing in.
Okay, so I've got $100,000 in RSPs.
That's right.
You're Mark the Builder.
That's correct.
Okay,
yeah.
And Mark the Builder needs some money to do for what?
To build, to go, we've got a site-approved site, and we're ready to go right into construction. We need some soft-cost financing.
Okay, so you've already bought the land.
We've already bought the land.
So we don't need money for the land. You've already bought it.
That's right.
And so what I'm going to do is I'm going to give you a mortgage so that you can build this product.
That's correct.
The condominium of the houses. And my money is secured on the land.
That's correct.
So exactly like a bank.
That's exactly like a bank. So instead of a developer having to go to a grade A bank, he would go to a company like Valor, or actually ProFunds, the company that that underwrites the mortgage, and basically says, look, I need money, and we say, okay, here's your rate of return. We then go to ProFunds then goes, raises the capital as a mortgage. Yeah. That mortgage goes on title just like a bank. So when you look on title, you go on and do your MPAC or you get your real estate, you can see who's the mortgage holder, your name will come up.
Okay, so I've only got $100,000 in RSPs, and you need $5 million. As the builder.
That's correct.
So it's going to be Rav now and friends putting our money together from our RSPs or from cash. I guess you can do cash as well, but we're talking about RSPs here tonight.
That's right.
So we're going to put our money together. We're going to lend it to Mark the Builder. We're going to secure on land, and you're going to pay us a return of 8% per year paid at the end of the project, per year, monthly.
It depends on how as a developer you'd want to work that. It can be monthly, it can be quarterly, it can be yearly. As well as that, we also do a deferred lender fee, which at the end of the project you would get another 8% or 5%. Again, it depends on the project, but 8% is probably the going rate that you can go with for a 2 to 3 year period, and then in the end you're going to get what they call a deferred lender fee, which could raise your total take. Upwards of 12,
so
15,
so the last project you just did, the Valor Capital. So a capital company really is just a company that raises funds for investments.
Well, I got to be clear on this. Valor Capital puts the projects together for a mortgage company that is the administrator of the syndicate.
Okay.
So Valor Capital works with developers. We work with developers. We sit down and hammer out a deal. We structure it where we at.
But in general, a capital company is the one that kind of raises funds. No.
Through the developer,
you have a marriage with ProFunds.
That's correct.
Valor Capital and ProFunds have a marriage. So
100%.
For all intents and purposes, it's not one, but it's one in a sense.
We're connected at the hip.
Okay. And so a builder comes to you and says, hey, Valor Capital, hey, ProFunds, we have a project. We've already secured the land. This is what we want to do. We need an extra $5-10 million. Can you get it for us? You say, we can get it for you, but let's hash out the terms and conditions.
And you got it.
Okay, and so what we're going to do is they're going to say, yeah, we're going to give you 8% to your people. We're going to give you 8% paid quarterly.
Yep.
And then it's a 3-year project. So altogether it's 24%. But at the end, we're also going to give you an additional 12%.
That's right, when
at
the project ends.
So it's all together maybe a 36% return over 3 years, 12% a year.
Yeah, I would say I would like to we like to be realistic and say it's 12% a year, but over 3 years that would be 36.
And
I
anybody
think that means a bit deceiving because some guys say, oh, you're getting 36%. I'd like to say you're getting 12% every year.
Yeah,
that's the better way, I think.
Paid monthly, paid quarterly.
Monthly, yeah, depending on how we structure it.
Okay, so obviously, I know now why the banks wouldn't want people to know this.
That's for sure
Because we're taking away their business.
That's right. And when you look at just recently, RSP season says come put your money in here. Well, yeah, because the banks then use it, and they end up making their money. What we're saying is hey, you self-direct your RSP into a alternative investment, which would be called a syndicate mortgage, and it's going to be secured on title with a development project.
Okay.
And that's how we would do it.
Okay, so how does one get started? Because really what you're saying is you're telling all of Peel Region, if you have RSPs, don't settle for the negative, don't settle for the 0%, don't settle for the 1-2%. You can make 8, 9, 10, 11, 12% per year.
In fact, I'm not just telling Peel, we're going to be having a seminar on this on May 30th at the Sheridan, right on Airport Road there. May 30th, 7 o'clock. We're going to be having a full-fledged seminar, so you can come, you can ask all the questions. We're going to have a lawyer there, ProFund's underwriter is going to be there, as well as an accountant, because there's tax implications. You know, people say, well, how does it affect? It really, it's for us. I mean, I've been doing it so long, it's not that complicated. But the main step is that people need to start saying, you know what, I need to take control of my
retirement. But let's break that down further. You just brought it up, taxes. I'm not paying taxes on it because it stays the money, my profits comes back into that register fund, right?
Absolutely right.
So it's not like I'm getting taxed on it because it's just like an RSP. When I make a profit in my RSPs, I don't get taxed until I take it out whenever I want to take it out, the age 60, 65, 70, whatever it is.
Well, like I said earlier, the RSP, the first word in RSP is retirement. So people need to start saying, you know what, if I'm going to retire, I'm not going to retire at 3%. I got to start punching my numbers up. When you hear a lot or you read a lot of books about people saying, well, every 6 years if you're making a minimum of 15%, well, how are you going to make 15% if all the banks are only paying 3%?
Sure.
What we're trying to say is, hey, we can get you up to those numbers. And you're not going to get taxed on it, as you were saying, because it stays in the RSP. It's fully RSP eligible. Okay. So it's just you control the investment.
Okay. So Mark, you're the builder. I'm Rav and friends. We're going to raise $5 million. We're going to put it together in a limited partnership.
No, limited partnership structure is something that we'd look at from an exempt market.
Okay.
Now, the builder may have a limited partner, but for the RSP holder, that doesn't matter. All he wants to know is that his money goes into a self-directed trust. Yeah. The builder doesn't.
Who helps me with that? Valor?
Yeah, we can. ProFunds would direct you.
ProFunds will help me do that.
There's only a couple companies, and these are fully registered trust companies. Okay. And they would handle the trust, and in reality, we don't see the money at all. It stays in the trust, and statements are issued from the trust company as to how the money.
Okay, so we're giving you the builder, Mark the builder. We're giving you money. Suppose you're the builder, which you're not, but let's suppose you are. So we're giving you the money. We're securing it against the land. Just like a normal mortgage.
That's correct.
So, for example, if I don't pay my mortgage on my house, it's a power of sale, and you're going to take my land away, if you will, and sell it. So, if the builder defaults on these payments, 8% per year.
That's right.
If the builder defaults, if he can't do it, if he reneges, if he leaves the country, I now have the land as security.
That's correct.
So, what's the ratio? What's the loan to value, if you will? Is there enough? Is there going to be enough money there in the land? The appraisals. Help me with all that kind of stuff.
Well, and that's probably the most technical and the best question of them all is that how the money is drawn out is based on loan to values. So, for example, when we first come into the property, most times you don't go above 80% LTV, which is loan to value. If we
what does that mean? So the land costs $10 million.
Well, let's say, bring it down.
$1 million.
Okay, $1 million.
Yes.
Then 80% would be $800,000.
So
there's still $200,000 of value still left. Equity, they call it, but I call it value that's left in the land.
Who put that $200 there? The builder?
The builder would put that in.
I see. Okay, so there's $1 million worth. There's $1 million worth of land.
That's correct.
We are taking our RSP money and putting $800,000 towards it.
That's correct.
The builder's putting $200,000. So that's why you're saying the loan to value is 80-20.
That's correct.
So I have that margin. So if the builder were to flee, and the Greece didn't pay their bills,
that's right.
The economy were to go down, I've got a buffer of about 20%.
You got a buffer, and Can some are 70? Like I said, when we put these deals together,
Yeah.
if they're higher risk, we say, you know what? No, we can't go above 70% loan to value.
Okay.
If some projects are ready to go, where they're ready to go right to construction, we know that, oh my gosh, or we may even have leases signed. What if you got leases signed? What if you've got people lining up to buy the place?
Yeah.
The risk factor drops while adjusting the loan to values is really the risk involved
Yeah.
in a structure like this.
Okay. And so we come in, usually we try to come into first position, second position in terms of where we are on the mortgage. So we're the first ones to get paid out if something were to happen.
There's two structures we look at. One is the soft costing, and at sometimes the purchase. You go in with the developer to purchase the land, and you'd be in first position. When construction financing, in other words, you've got everything set to go. You've got pre-sales, you've got leasing, you've got everything ready. The city has approved it, stamped it. You're ready to go.
Yeah.
We then would organize or structure the construction financing. Construction financing replaces you. You're bought out. You're done. You get your money.
Wow.
And the construction takes over.
But I still keep making my money.
Or you can come in as in the construction financing with your RSP.
Gotcha.
What I'm saying, there's two types. Is the beginning phase? Let's face it, Rav. At the beginning is the higher risk. When you're into construction, that means you've got sales. That means you've got stuff.
We've sold out
We're
already.
sold out.
We've got...
And so, as I was saying, the risk factor drops. Well, that's why also construction financing, your rate of return is lower than the 8% or 10% or.
Okay, so can we disclose a deal that we've closed already?
We can,
Yeah,
sure.
can you break it down? So tell me kind of where it was, how much we needed, how did it work, and how much did the investors make?
Okay, so we have we like to look at infill projects. We like to look at stuff that you're in and out quickly. We don't want to do what we call site planning. Site planning to us is what we call a whole. Not every guy doing this does that. But we like to stick with.
So in and out means what? 2 years?
2 years.
Okay.
2 years.
So 2 years max.
So project turnaround. So we have a project in Barrie that we bought the land for $680. Okay. We raised approximately $600.
Okay, so it's a piece of land.
$525. Sorry.
So you round the numbers a little bit. So there's a piece of land in Barrie for $700,000, and you needed $500,000.
That's correct.
And so you raised $500,000 through RSP money.
That's correct.
A whole bunch of different people. Rav put in 50. This guy put in 100. This guy put in, and so we had how many investors altogether on that?
Well, there's such a demand. We only had 6.
You only had 6 because everybody wanted to get
everyone
in.
just $100,000.
So
I'm in. In fact, we had guys lining up.
So you had 80 or 90 grand per person.
Yeah.
So you raised the $500,000.
Yep. Paying 8% a month.
Okay.
With a deferred lender of 14 at the end, you're getting 22% of your money.
22%.
20%.
Over 2 years, so 11% per year.
If you average it out, yeah.
Yeah, 11% per year.
No, 14% a year.
14%.
Yeah.
So you're getting 8% per year.
Yeah.
Right?
No, sorry. 8% every year.
Yeah.
And then 14 at the end. You're getting a 14 kick at the end.
Wow. So that's 15%.
15%.
8 plus 7.
That's right.
Per year on
right.
average.
That's right.
Okay.
That's not a bad deal.
No, that's not a bad deal.
It's closed, and we're just building simple family homes. We like to keep it simple. I call it build stuff cheap and cheerful. Middle of the road. If you go fancy schmancy, you end up cutting. We want to 3 bedroom, 2 bath, real simple, real straight. People buy that stuff all day long. That's what we want to build.
So somebody's watching the show. They give you a call tomorrow. Your phone's ringing after the show. Whatever. How long does it take? So I've got my RSPs set up. I've got a financial advisor. All that kind of stuff. Is this just a phone call and it gets set up within a day, within a week, within a...
Well, I mean,
like
again,
what kind of legwork am I doing? Any?
The only legwork you'd have to do, for sure, is call myself. I'll pass you on to someone at ProFunds because it's basically a mortgage. We're not a mortgage company.
Yeah,
ProFunds
it's a mortgage.
So they would pass you on to one of probably 2 companies that we work with. It would be up to you to call that company.
Those companies are trust companies.
Trust companies.
Because we've got to take our RSPs. Step number 1 is we've got to take those RSPs and put them in a trust.
That's right. You have to. You have to direct. Let's, for example, say it's sitting at a bank.
Okay.
You have the number for the trust company. You call your bank and say, I want to move my RSP to this place. They're going to say, oh no, don't do that, please. And you say, well, I want to create a self-directed. They have to. It's your money.
Okay.
They move it. That can be done in a wire transfer. It's sitting now there. That you then direct that trust company to say the money is going to be used as a mortgage for ProFunds. That's it. It can be done in 24 hours. You're absolutely right.
And so the bank's making no money now.
The bank that you had the money at is making no money. That's
making no
correct.
money, and that's totally fine. And of course, the big banks are owned by the government, and so then therefore they don't like this. No, but seriously, and that's because there's people watching right now, and they're thinking, what is Rav and Mark talking about? Because nobody knows about this. And the reason why they don't know about this is because the banks don't want you to know about it because they're not making money anymore. We're a competitor.
And you know what's been happening is Scotia and TD had great self-directed RSP options. Guess what? They no longer offer them because it's the groundswell, the demand for self-directed from people like us that are getting the word out there. They're realizing they're not making money. How can a bank make money if you're self-directing it yourself, saying, you know what, I want the money to sit in here and I want you to put it over in this project, where the bank's saying, no, we want you to put it in our project. Yeah. And then you say, no, I want to do mine. I'm getting 8% here. You're only saying I'm paying 4%.
Sure. Well, of course. I mean, everybody would be doing it. See, listen, most people that put their money in their RSPs don't know where the money is. They think it's in RSPs. But that's really just a fancy name for a savings account. Right? That's all it is.
That's exactly
and
right.
So people don't even know, where their money is and what they're making. Why not say, I want this money, my RSPs, to go to the development at 123 Main Street in, Caledon, Ontario.
That's exactly
And so
right.
then they can make their money there. They get their fixed return
Yep.
of 8%, paid monthly or paid quarterly, and with a little bit of a kick at the very end based on how the profits do.
That's right.
Right?
And in that, I guess the mortgage agreement, as you call it, we would list out basically how the project would work as well. Because transparency, ProFunds is the underwriter for it, and they would have to make all the project list out and how the money gets transferred. 8% at the end is this, the term, the rates, everything is listed out there. Okay. And then you get independent legal advice. You can make sure your lawyer's okay with it, and away you go.
Folks, this is the Call-In Show. 905-595-5483 is the number to call. Give us a call, talk to us, ask us anything you want real estate related. The topic tonight is about taking your RSPs and making some good returns by investing it, you being the bank, and lending it to a builder. I'd love to hear your thoughts, comments, questions, sing me a song, some poetry, all that kind of good stuff. So, Mark, as this has been catching on in the last few years, there's been other, it's not just ProFunds Valor, doing this. There's other people that are kind of getting involved, and there have been not always the best stories with other companies. What are we looking for when we look for a company, a mortgage company, to help us to become the bank? What are we looking for? What type of, I'm always big on integrity. What kind of questions should we be asking?
Well, I think like
somebody's watching the show. They tell their coworker, "Man, this guy, he wasn't only a good-looking guy, but he's knowledgeable. His name's Mark Vosylius." And the coworker says, "No, don't go with Mark Vosylius. Go with this person," which may be great to go with that other person. You mean, why not? There's many people out there to be able to help. But what are we looking for? What are the questions to ask?
Well, that's a great question, Rob.
Being objective, as objective as you can. Yeah.
I mean, like I know. The first thing I do is I'm a pretty techie guy. I Google. I start Googling names.
Okay.
And you just say, what the heck? What's out there? Again, you'd be surprised what comes out there. So that's number one. I don't know if that's number one, but I know that's what I do. Who's this guy I'm talking to? Who's this guy claiming to be?
Yes.
Google him. Number one. Number two is experience. Has the guy, have they done anything? Has ProFunds done anything? Length of time they've been doing it. I mean, I know that Carmen at ProFunds, she's been at it 25 years. She's done over $1 billion of underwriting.
Wow.
I mean, she's a little dynamo.
Okay.
And so experience, length of time, and like anything, track record. Right, successes, not successes. Is this something I just started now? No, this is something I've been working on for a long time. I wrote my business plan, as you know, back in 2004, almost 10 years ago now.
Yeah.
To be doing what I'm doing right now. It's taken me this long to get here.
So you're in real estate development. You're helping people to invest their RSPs. Are you still doing the normal,
rental property thing?
Well, you had 65 tenants at one time.
Yeah.
At the same time.
Yeah, I did. Yeah.
Do you still kind of do that? Are you still looking for properties, good deals?
Well,
here and
you know
there?
what? I'm a true believer in real estate, as you know,
Yeah.
and I believe in, I'd like to diversify real estate. You talk to financial planners, they call diversifying your portfolio. I like to diversify real estate. So yes, I still have a couple rental properties. I sleep at night now. My weekends I can spend with my kids. I don't have to clean toilets on the weekend, and I really like that. When I came down
You don't have to clean toilets because you don't have that many properties anymore.
It's just the numbers is just, I call it after 15 doors. I don't care what anyone's saying. Every weekend there's going to be a phone call if something's wrong.
Yes.
So
even if you have property managers, because then you're managing the property managers.
Yeah, exactly.
Okay.
And and it's hard to find property managers to manage anything under 20 doors anyways.
Yeah.
Because they just don't exist. It's got to be in one building. Otherwise they're not profitable.
Sure.
So I'm just realizing that I looked at those 65 doors and I said, you know what? I wasn't making enough money, and I looked at alternatives.
Good stuff. When we come back from the break, we're going to get some callers on the phone here and
talk about that seminar.
We're going to answer some questions. 905-595-5483 is the number always to call. Thanks for watching. In Tune with Real Estate continues in a moment.